Thank you for joining today for my 2025 Multifamily Outlook. In this presentation, I'm going to go through some of the trends and various factors that I'm currently watching for the 2025 year and how it'll impact multifamily performance along with other investment performance. This presentation is basically broken into two overall outlooks and considerations. The first is basically looking at transactions and transaction impact. So this is buying and selling multifamily assets. And the second is the impact of the economy on renters, which ultimately drive the top line revenue performance for the multifamily space. I'm going to go through these, and then I have additional detail behind each of these that I'll touch on. The total presentation will run about 25 to 30 minutes. If you have questions, feel free to put them in as the chat. I have disabled the ability to ask questions over the phone. So if you have a question, please submit it via the chat window. So when I look at overall transaction activity, it continues to be very limited in comparison to pre-COVID. And this is still for the same reasons of obviously elevated interest rates have prevented buyers from acquiring very many properties. While a lot of funds also thought we'd see distressed assets hitting the market more in 2024, the distressed market space hasn't really played out the way a lot of funds thought it would. And partly this is because of the change of who lenders are. There are fewer banks making loans into multifamily real estate. We've seen more credit funds and more agency lenders. And these lenders have more flexibility to work with borrowers. And the term that's been thrown around quite a bit in media is the extend and pretend. And what that means is basically lenders have allowed borrowers to continue to go as long as they're making payments and to try to push off maturity defaults and other defaults because lenders really don't want to repossess assets. And so what that means is that basically we've seen fewer forced sellers, we've seen fewer foreclosed assets, and so there's been fewer distress opportunities. And then on the stabilized side, there's virtually very little, if almost no transaction volume whatsoever. Both at the Class A, Class B, and Class C. Total transactions are down 90% still compared to 2019. 2024 definitely saw a strong uptick in comparison to 2023. And I anticipate with rates starting to come down at the end of 2024 that we will see a pickup on transaction activity in 2025 as some rent growth in some markets combined with lower interest rates will allow some borrowers to potentially come back into the space, acquire assets, and start to work on projects. My personal expectations, so these are some of, based off of my own research, these are my expectations for 2025. I expect Fed funds to basically decline. So this is what the Federal Reserve sets. I expect it to decline another 50 to 150 basis points in 2025. I think at the next Fed meeting, I would not be surprised to see no decrease. And I think the Fed will be very slow going into 2025. And I think in particular with the change in the administration and several of the economic policies the new administration is looking to implement, and in conjunction with macroeconomic events, I think the Fed will take a very cautious, very slow pace approach on rate declines. So really the Fed funds rate is what sets the prime rate, and prime is effectively what sets the bridge market and the regional bank lending market. So these are two of the main borrowers for buyers. Typically in secondary and tertiary markets, you see regional banks play a very active role besides Fannie and Freddie. And then in particularly large projects, rehab projects or construction projects, bridge lenders are predominantly the ones making the majority of the loans. They're very high leverage. Currently, bridge rates are somewhere between 9 and 11%, which is down from 12% last year. But these are still going to wind up being limiters. So as those rates continue to fall, we expect to see bridge maybe back into the sevens or eights in 2025, which will allow a lot of projects to happen. Uh, and then we expect to see regional banks come back probably into the maybe high sixes and low sevens during 2025, which will allow more activity to happen in secondary and tertiary markets. I think the 10-year, and I'm going to talk about this quite a bit. So the 10-year is really what winds up setting cap rates in the space because the 10-year is how agency basically pegs its interest rates. That's how the CMBS markets pegs its interest rates. And so the 10-year is a very important benchmark rate. And the 10-year is very volatile. And there's a lot of reasons for that. And I'll touch on a few of those in this presentation. And I expect next year to look a lot like 2024, really the last 12 months, so late 2023 and through 2024, where we've seen extreme volatility in the 10-year. Last October, so October 2023, rates got as high as 5.1 on the 10-year. And during the fall before the election, it went all the way to 3.5 and went back to 4.5 after the election, and we're back at 4.1. What that means is it makes it really difficult for banks and everyone else in the space to peg loan products because the pricing changes and those changes are significant. Because a 1% change in interest rates could affect loan proceeds on a project by as much as 10, maybe even 15% on a go forward basis. So the volatility of the 10-year is problematic along with the overall rate of the 10-year. Ultimately, I think the 10-year will climb closer to 5%. There's two main reasons for that. One, historically, the 10-year has traded at inflation plus 2%. And so that would probably put us somewhere around 5%. The second part of this, and I'm going to touch on this in a lot more detail, is the US deficit will continue to be large. It will continue to grow. And all of that will put more borrowing pressure and basically keep rates elevated as the government will need to pull more money out of other investment spaces into the government to continue to fund the federal deficit. The other thing that's impacting in transactions, and this doesn't get as much detail, but these are still two major factors are insurance and property taxes. So these are the largest expenses for multifamily and really all commercial real estate besides payroll for multifamily. Property insurance has increased substantially, and it started to pick up during the first Trump administration when he passed tariffs on Canadian lumber, which basically pushed up construction prices because effectively the insurance rate is based off of the cost to rebuild a property that's destroyed. Also, what we've seen, particularly in the Gulf Coast region, but this also has played into insurance rates for the rest of the US, is obviously we've seen a string of several large hurricanes causing hundreds of billions of dollars in damage, all of which factors into a higher market. And then if you get into the Midwest and Texas, substantial hail events, while not causing a major crisis or loss of property or destruction, is a very significant factor in insurance calculations as basically roof claims are the number one property insurance claim besides hurricanes. So basically those are the reasons insurance has climbed. And I'll touch a little bit more on what I think is going to happen in insurance, but basically insurance is tight. The space is very much an oligopoly. There are very few companies offering insurance. So because of the limited competitive nature of the space, along with rising costs and rising claims, I expect insurance to stay expensive going into 2025 and really probably for the next 2 or 3 years. Property taxes also have been kind of a sleepy category, but they've picked up steam during inflation because the governments, your state and local government, so your city government, have similar problems to companies and consumers, which is they have to pay payroll, they buy materials, and all of the things that your municipal and state government have had to procure have gotten a lot more expensive. And for most places in Texas, Illinois, property taxes make up the bulk of uh, tax collection in those states, besides sales tax. And as the governments need to increase revenue, I actually expect to see potential increased tax rates, and then obviously increased valuations in the states that have multiple valuations, just to continue to fund the ongoing local budget and government initiatives. Also, in terms of demographics, the U.S. has seen a slowdown in total immigration, and also natural birth rate in the U.S. has slowed down over the last 20 years. And what this means is that a lot of the municipal pension programs that were built on increasing populations now have to be funded with a smaller workforce or a smaller working age in their communities. And the impact of this, it really means is that that their pension programs, particularly for police and fire and government workers, will have to be supported through probably higher tax rates and higher valuations to actually justify those collections. On the other side of the business, so those are the things, because basically higher insurance, higher property taxes, higher borrowing costs, all of this puts pressure on transaction or asset values within spaces. Now, the second side of the equation is basically rents. So basically, as rents and projected rent growth is strong, it allows buyers to pay more for assets. The renter side of the multifamily space has been challenged. And it's really for a lot of the same reasons of the top half regarding transactions. But it really primarily has to do with inflation. So we continue to see basically this idea of a K-shape, kind of a K-shaped recovery in the economy. The very top of the economy is humming along. So the top 1% of wealth and the top 1% of income have done very well the last 5 years. The middle class have struggled, and that's really going to be the bulk of, apartment renters are going to fall somewhere in this middle class category. Class A, it's upper middle income, young professionals. Class B and Class C are going to be middle and lower middle class, either individuals or families. But interestingly, the very bottom of the economy has actually fared okay. And part of this is obviously massive expansions in various government and nonprofit programs related to COVID. Also, obviously, transfer payments from the government during COVID. But actually, the situation at the very bottom of the economy is slightly better than it was 5 years ago. So the very top has done well. The middle class has struggled in short order. Really, the story around renters is they're getting hit hard by inflation. So for the middle and the lower middle class individuals, the inflation numbers actually don't do justice for what they're running into, because really as a percentage of their disposable income or their take-home income, inflation is actually running much hotter than the reported number at the national level. And that's because basically car insurance makes up a bigger proportion of their budget. And so changes to things like car insurance, cell phones, food costs, gasoline have a much bigger impact on them than the headline number. So the reality is when inflation maybe is running 5%, the actual impact for most of those families is more like 15 to 20%. And so it makes a significant reduction in disposable income. Now, these are my thoughts on inflation. I think inflation, obviously, while it has tapered off to some degree and has getting closer to reaching sort of the normalized 3%. That number is really dependent upon two major things. I'm going to go into this in more detail, so I'll just touch on it here. But basically, energy prices and the strengthening of the U.S. dollar. With that said, there are significant risk factors looming in 2025 that could put pressure on either the dollar or oil prices. Obviously, wars in the Ukraine and the Middle East could put production at risk. Obviously, Russia, if resolved, Russia coming back in the energy fold would actually probably lower prices. Simultaneously, any expansion in the Middle East conflict between Israel and other players, or an expansion between other players, could put some of the Middle East's significant production at risk, which would drive up prices. Also, that don't things that don't make the news quite as much. Venezuela supposedly is looking at possible invasions of Guyana, and then obviously the China-Taiwan conflict continues to be ongoing. How both of those will unfold in 2025 is yet to be seen, but they both will have impacts. Uh, they're because of Venezuela's production and its importance to U.S. oil prices. Any kind of major sanctions, Biden actually lifted sanctions against Venezuela to lower prices at the pump for the election year. But any major sanctions against Venezuela, we could see a strong surge in energy prices in the U.S. And then obviously with Taiwan and China, if that becomes a ballistic war, oil prices will get stretched pretty hard. The other thing that's interesting and very much worth noting is the rise of nationalism. And this is something I follow pretty closely because while not an immediate impact on multifamily, it will cause a large domino effect to happen that will have a major impact as we look 5 years out. Because when I look at projects, I'm not just looking at year one, I have to think about year 5 through year 7. And so the performance of multifamily assets, particularly in the private side, is heavily dependent upon the world 5 years from now. And so this to me is one of the major trends that I spend time looking and reading about because it's one of those things that poses a major risk. What we're seeing in the US in terms of nationalism, this idea of tariffs reemerging, it's not just unique to the US. Actually, in fact, nationalism has become very popular across all of the world for the last 5 years. And it's really being driven by a lot of the same factors and messaging both in the US and Europe. And really, what it is the middle class in those countries have been hit hard by the rise of globalization and offshoring of jobs to particularly Southeast Asia, but elsewhere in general. And what that means is that basically it's kept wages pretty low in those economies, and people's patience level is boiling over, especially as inflation really stripped away their earning power in those countries. France is having a second snap election, or that looks like they're going to, as basically a new vote of no confidence is emerging this week. So potentially the French government could be dissolved again, which could throw France into crisis mode yet again. The Nationalists just missed out on the last election, so you could see the Nationalist Party take power in this election. And then Germany has seen a rise of a far-right nationalist group called the AfD. And that group has picked up significant power in German parliament and will continue to do so. And what that means is that, where the UK exit from the Eurozone was a shock, the possibility of Germany leaving their European Union is a very real thing. There's a very large segment of the German population who's become anti-European Union predominantly due to immigration, various refugee groups from the Middle East. But overall, also because of energy policies and other things. So there's a real possibility that Germany could take a very surprise UK maneuver and look at leaving the EU. But so those are more long-term factors because any destabilization of Europe and this rise of nationalism ultimately will push up interest rates across the world. And these are things that will lead to the higher probability of ballistic wars between people who are considered to relatively be at peace with each other. But typically, these are how these swing. So the early 1900s, the trend of globalization looked very similar to now. And then very quickly it reversed into World War I, where nationalism rose the 5 years before World War I. And then very small things turn into big things, and that's how you get a ballistic war. So let me move on, and I want to talk about some of these in a little bit more detail. When I look at overall the entire commercial real estate space, uh, apartments are hanging in there. Industrial has continued to do well. There has been a resurgence in retail demand from a lot of new startup businesses. That trend in 2024 caught a lot of people off guard, me being one, just because it didn't seem like the source of disposable income was there to justify expansion of retail businesses. But we've seen a lot of suburban retail growth and a lot of demand for local services. And I think that that will continue to be strong performers. I do think because of the way retail investments go, because you had people close businesses during COVID, and now you're seeing businesses reopen. Typically, retail businesses, their turnover rate kind of runs on 2-year cycles. So basically, 24 and 25 will should be good, and then you'll start to see retail probably have kind of a negative pullback somewhere in 26 and 27. Obviously, for people who follow the news, U.S. office has done very poorly as companies have substantially downsized in major markets that were thought to be ultra safe, including New York, San Francisco, Los Angeles. And these markets have been hit very hard, have significant office vacancy. Asset prices have been absolutely ridiculous when they've traded hands. For example, US Bank Tower in Los Angeles traded at a 70% loss earlier this year from 10 years ago. And there's numerous examples of these assets trading hands for a fraction of what they were acquired for 10 years ago. Multifamily continues to hang in, mostly because of the ability of apartment owners to pass along some costs and manage rents somewhat effectively. And so we've seen property owners be able to hang in and manage through the challenge. One of the things I wanted to talk about basically is the rise of the US deficit. As I mentioned on the first summary slide, the US deficit has grown significantly. So this is the US annual deficit. So basically, this is what the government incrementally has to borrow every year in terms of, in addition to what it's refinancing on an annual basis. So as you can see, this chart here I've set up basically color coded by party. One of the key takeaways is both parties spend money, and both parties spend a lot of money, and both parties have increased the deficit. What you can see is if you look at the years, actually, I've staggered this chart deliberately because, for example, Trump was still in office in 2020. The 2021 budget is set in 2020. And so I've staggered this a year because really the budget was set by the previous party the year prior. So what you can see is basically, obviously, COVID. We saw significant additional spending during COVID. But since COVID, the deficit has grown exponentially, almost without explanation. We continue to spend more money on goods and services, but yet there's no clear result of what any of that's doing. This phenomena is also not unique to the US in any way, shape, or form. What I've shown above is the annual deficits of, the other, basically the historical G7 minus Russia. And what you can see is China has really expanded its borrowings and its annual deficit. This is mostly to support construction and several of its social programs along with military spending. Japan continues to run a pretty substantial deficit, which has been going on in Japan for quite some time. But then if you look at Western Europe, it's interesting. I mean, Western Europe, the three major powers of Western Europe have all run significant deficits as well. So when you take this in totality, the projections for next year are that these six governments need to pull $4 trillion of additional investment out of the private space to fund the budgets for 2025. There's a theory in economics called the crowd out theory, and it's that the government always crowds out all other investment products because it can basically set its rates the most attractive for the risk, and basically can also then require legislation that mandates people actually buy its product. 2020, so I think next year, this is why I'm so concerned about the 10-year, is at $4 trillion next year, and then it's 4 trillion the year after, and the year after, and the year after. There is a limited amount of capital in the world to flow to these markets. While it has seemed unlimited, the reality it is not. And at some point, there will have to come a reckoning where eventually interest rates will have to go higher and incrementally higher to keep causing more investment to flow into the product offerings. So because of the increase in the deficit spending, this is what I think will ultimately put the most pressure on the 10-year in the US, and basically why I expect the 10-year to climb closer to 5, just because it's going to need to go higher just to continue to push more investment into it to fund the ongoing deficit. The other thing about specifically about the US 10-year holdings is the people who have changed, or basically the historical buyers of 10-year treasuries has really changed. And this is why the US Treasury has also gone shorter duration, and more of the government debt is now financed on basically 30-day, because effectively they're borrowing from money market funds versus 10-year or longer term government notes. Basically, you can see here what I've said is you have all of these other groups, other countries, and intergovernmental agencies. Those are going to be very limited parties to be able to acquire and support that ongoing additional deficit spending. The majority of it's going to have to come from basically the public or US commercial banks. But commercial banks are going to be reluctant to go longer duration because of some of the risks that they've been exposed to in the last 5 years. One of the things I also want to talk about here is just talking about the volatility of the 10-year. This is what I mentioned earlier, is the volatility along with the rate have been one of the main challenges for borrowers to buy assets. What this is this is one of the measures of 10-year volatility. So basically, this is a comparison of basically the min and max in a year as a ratio. There's also some measurements basically of the median, the ratio of the median to standard deviation, which has basically a similar chart to this, which is historically its volatility in the 10-year has been low. And since COVID, volatility in the 10-year has picked up pretty heavily. I expect 2025 to not really be any different, particularly with the economic policies looking to be implemented. I expect to see a lot of uncertainty in the 10-year. And so I really do think that we'll see probably from floor to ceiling next year, 150 basis point swing in the 10 years possible. I think 200 is outside possible, which would be probably like a 3.5 to 5.5 as a real outcome. When I talked about property insurance earlier, this chart basically shows the annual change in the National Property Insurance Index. So this is the index that measures the cost of property insurance across the country. And as you can see, basically property insurance has been pretty stable from 2007 all the way through COVID. And then really after 2022, it really picked up, mostly driven by inflation, but also kind of a handful of other factors. One interesting note on this chart, part of what drove insurance in 2002 was government changes, legislation that got passed that basically required terrorism insurance to be collected, along with some changes to litigation and lawsuits. And so the market went through a very rapid expansion of higher premiums before tapering back. But as we go forward, I can tell you 2025, because we've already seen the cost calculations, is probably going to be up probably close to 10%, maybe 12. So we're going to be in this continuing period of very high insurance growth going forward. Now, I want to switch gears for a few minutes and basically talk about renters. So there's some interesting changes on the rental space for US multifamily. And this is where obviously as I run our business, we spend a lot of time looking at these macro changes because we see them at the field level. Uh, but not just at the field level, we see, and then we see how they impact the property performance, and then we see it show up in the national trends. The first one, and they're all interrelated to some version of the inflation economy story, which is partly also what drove the recent election results. So turnover across all multifamily properties in the U.S. has significantly picked up since COVID. A lot of this is driven by people not having means to pay. Also, a whole cohort of renters got used to free rent from the government or got accustomed to properties not being able to evict, not realizing that properties could eventually evict again. And so what we've seen is that we're seeing much higher rates of skips and evictions than we've seen pre-COVID. And the same numbers are being reported in virtually every one of the major metros that reports eviction rates. We've seen a significant increase across the board. Now, on the eviction and skip side, I mean, to me, they're really one and the same. People are making less money, or as they're making the same amount of money, they're spending more on goods and services, and those goods and services are more expensive. One of the things we've seen because of the overall state of the economy is we've also seen people move in together. And so we've seen this show up in the national data, which is basically the renter pool has actually shrunk. As you can see, the market shrunk pretty heavily in 2020 as basically people moved back home or moved in with families. So that's predominantly explained by students returning to family, and then obviously going back in 21. But what's interesting is what we saw in 2023 and 2024 is we saw the same impact where we're seeing basically one of these three combinations. An elderly parent living with their adult children. We see significantly fewer elderly renters than we did 5 years ago. We also see young 20s moving back in with their parents, grandparents, or another sibling. So this is typically, a 22 to 24-year-old. They get financially pinched, maybe lose a job. And typically we see them basically relocate back to living with their family or with a sibling. And so what that means is that the market as a whole has slightly shrunk. And anytime the size of the renter market shrinks, vacancy is going to go up. Now, when you factor that there's fewer renters, and on top of that, all the major metro markets have seen additional construction. With those two things combined, basically this is one of the fundamental drivers of why you're seeing vacancy increase across the U.S. In comparison to 5 years ago. The only place where this story hasn't really played out that way is in the markets where new supply is either basically prohibited by zoning, has a natural geographic constraint, somewhere like San Francisco, or alternatively, basically doesn't support, the job market in that area doesn't support new construction rents. But for all the other major metros, this is a major explanation of why you see a huge spike in vacancy compared to 5 years ago. One of the things I talked about wage growth, and I talked about income, because obviously for renters to pay more in rent, they have to make more money. And so to me, this is a chart that we look at the most, and this is how I think about forecasting and thinking about where rents are going to go in the future. So this is real wages. So this is nominal wages adjusted for inflation. So basically, when inflation is high, if they have high wage growth, those two offset. And so 25th is basically the bottom. That's going to be the bottom of your workforce. These are people making about $25,000 a year. 50th percentile are going to be people making about $45,000 a year, and the top make about $75,000 a year. What is interesting is all three of these groups, basically on an inflation adjusted basis, are basically making no more money than they were 5 years ago. And even more so, like I talked about earlier, the reality is if you really factor inflation, how it's impacting them, the reality is they're most likely all making less than they were 5 years ago. What this means is that with that reduction of real income, it's going to basically put a cap on the ability of apartment renters to increase rents in the market spaces. Because ultimately, without families bringing more income home or having more income to spend, they will be limited in what they're actually be able to pay. The other thing I talked about for our renters, for all asset classes, and really talking about inflation, is it's really driven by two different things, and these two things are offsetting each other. So on the top chart is showing basically inflation and the strength of the US dollar. The US dollar, uh, when the Fed started to hike interest rates and aggressively hike them to 5.5% in 2022 and 2023, that basically caused a massive inflow into the US markets. And that's basically why we've seen this rapid strengthening of the dollar kind of over that same correlating period. As you can see, the dollar is now basically at the strongest point it has been in almost 25 years. And to some degree, that story of the dollar strengthening, while no one's really discussed it in the media, is the reality is actually why inflation slowed down in the US. Because basically a stronger dollar has allowed us to import more expensive goods at cheaper prices because of the relative strength of the dollar. Now, the dollar has peeled back some of those gains, and the dollar definitely is far from immune because what it'll have to do is as basically as the economy as they have to lower interest rates, basically this is where the major central banks of the Western governments have to work in lockstep to basically keep currency valuations stable. Because when currency valuations get stable or get unstable, it causes a lot of issues for international trade. One of the terms if you've heard thrown around was basically this idea of weaponizing the dollar. And that's basically what the US did, is it weaponized the dollar. So by making the dollar extremely strong, we've actually outsourced our inflation to other countries, and we've put a lot of pressure on economies and governments across the world because of it. And so you're seeing a lot of issues pop up in South America and Africa as they relate to that factor. The second part of the inflation story, and this isn't surprising, is basically it's the story of energy prices. Energy goes into every single good and service. And so higher energy prices basically turn into more inflation. Even if you strip it out of the index from a gasoline perspective, it still shows up as a transportation cost in every single good or service that's delivered to anybody anywhere. One of the things that happened on energy prices after COVID is obviously when Russia invaded Ukraine and the US basically dropped Russia and put sanctions on for Russian crude exports, as basically energy prices surged. And really, if you look at it, the timing is almost directly linked to the rise in US inflation. So when I talked earlier about the major macro risk factors and possible ballistic wars in 2025, I mean, this is really what I'm talking about here. I'm talking about potential, if there's any potential major outbreak and energy prices spike, we'll see a pickup in inflation, and then I would expect the central bank policy to be, tightening, which is very counterintuitive, because obviously, and this is where people have become very critical of the Federal Reserve, is tightening, tightening monetary policy during supply spikes or supply shortages. It's not effective because the only way to actually get energy prices back down is you have to increase production, and to increase production, you actually need cheaper capital. So it becomes very counterintuitive. But if you're looking at it just from an inflationary data perspective, and that's how they're treating it, then typically the policy plan will be just for that. What I didn't talk about in this presentation, because really there's a lot of rumors, but nothing to be seen. Two more factors that will really factor on inflation in 2025 are going to be the supposed tariffs that will be launched by the Trump administration against several key trade partners. We do think, or I think that I think some of these are likely. The magnitude, I think, is up for debate. But I do expect this to have an impact on construction materials, probably in the 5 to 10% higher range by mid 2025. And then, in addition, the supposed deportation policies that will be enacted, yet to be seen if that will actually be done as presented. But if they are done, and if they are done at significant scale, particularly in the U.S. South, I would expect construction labor to get more expensive because obviously immigration is a key source of construction labor for the majority of the southern U.S., including California, Arizona, Texas, Florida. And taking out that worker pool will make a very tight labor market incredibly, almost historically tight, which will just push up rates, which will push up insurance and push up cost to operate properties. So those are things we're keeping an eye on. There's really not much to be done about it. But I think that tariffs and deportation do pose major risks for all the spaces, but multifamily in particular, just because they will have dominoes that show up in other line item categories for the financials. And so as you look at projects, these are going to continue to put challenges on the financials, and basically are going to keep valuations, challenged until the Federal Reserve really cuts rates. But once the Federal Reserve cuts rates, that's going to be the major offset, and should help curb some of this. In terms of wealth and income, this is just a different look at what I had shown earlier. One of the things that's worth pointing out is basically as a percentage of wealth, the very top of the economy in the last 30 years has improved, while basically the U.S. middle class has actually significantly fallen. And basically the bottom's about where they were at. And then on an income basis, it's more or less the same story. You can actually see, so basically the biggest losers have been the true middle class and the lower middle class. And basically the gainers have really been at the top of the economy. And this is when I talked earlier about the K-shaped recovery or the K-shaped economy. This is what that K-shape is talking about, is basically the middle class and the lower middle class have lost economic ground compared to the 1980s, while basically the very top of the economy has basically picked it up as a percentage of total income or total wealth. And so that's why you continue to see basically the story of these two economies. But the issue is that at the very top, this very top cohort, they don't rent apartments. They don't rent nice apartments. They don't rent obviously lower class apartments. They're not in the apartment space because these are people that own 10 houses or 5 houses. So really when you look at Class A markets, it's really still going to be your upper middle income or even kind of the bottom of your upper income professionals. And while that group has done well, most of the gains have been hyper concentrated really at the very top of the economy. So just to recap, when I look at 2025, I think 2025, I kind of think of it as if finally we'll start to see the year thaw, and we'll start to see more opportunity for the economy to improve. I think that overall multifamily transactions, I think we're going to see more transactions in 2025. I think prices are going to start to recover. And then overall, I think rents are going to be tough to really see a lot of rent growth across very many of the multifamily markets. I think there are specific markets where you could see more or less, but I think across the board, I think in terms of true total realized rents, I think it's going to be probably flat. And most of that's going to be driven by limited real wage growth in the overall economy. Well, I appreciate you joining me today and hearing our thoughts for the 2025 Multifamily Outlook. I'm getting back to doing this on a quarterly basis, sharing some of our thoughts on the state of the economy and how they relate to commercial real estate. Um, if you liked this presentation, or if there's additional information you would like to see, or if you have other questions, feel free to reach out to me, and I appreciate you taking the time to join us. Thank you, and have a good day.